Bond valuation. So this is a new topic for us, and again I'm making the video for those students who missed the lecture. Now, what is a bond? That is the first question. So if you look at the definition of bond, it says a bond is a long-term contract under which a borrower agrees to make payments of interest and principal on specific dates to the holders of the bond. So in very simple terms, bond is a debt instrument. So let's say there is a corporation who requires money. Now when they need money, they might issue shares in the stock market, they might go to a bank for loan, it's up to them, or they might even issue bonds. Each avenue has different costs and benefits for them. So if a company needs money, they might think of issuing a bond. They will issue bonds in the market, and investors who have extra cash, they will purchase those bonds. When the investor purchases those bonds, money is raised for the corporation. So the corporation gets the money that they require by issue certificates in the market to the investor, and the investor gets an investment. So the investor will get interest payments from it, they will get interest income from it, whereas the corporation will have to pay the interest. So the expense for the corporation will be that they will have to pay the interest expense, and the benefit to the investor is that they will get the interest income. So if you have idle cash lying with you, one of the options you have that you might purchase a bond. Now there are some characteristics, features or terminologies that are specific to a bond, because bond is a special type of loan. Number one is par value. So par value is the stated face value of the bond. Par value, face value and even maturity value is the same thing. It is the loan amount in the bond. So if you buy one certificate, it will be considered that you have given a 1000 loan to the corporation. Different bonds can have different par value, but for study purposes, we will assume that the par value is fixed, it is 1000. In Pakistan, you can buy national saving bonds for a denunciation of 500 lakh as well. So if you buy one bond of 500 lakh, the par value in that case is a lot, but for study purposes we are assuming that the par value is fixed, it is at 1000. In very simple terms, the par value is the loan amount. Okay, so if you buy one bond certificate, this is the amount that will be considered to be the loan. Maturity date is the date on which the bond will end. Maturity is the remaining life of the bond. The maturity date is always fixed, but the maturity declines as time goes by. So let's say you purchased a bond that will mature on 2005, 31st December 2005 it will mature, and you purchase the bond right now. So that would mean that it has 5 years. If you look at right now, if it's 2000 and you just purchase the bond will have 5 years of maturity. But if you purchase the bond in 2002, the bond will have just 3 years of maturity. The maturity date is fixed at 2005, but as time goes by, the maturity, the remaining life of the bond will decrease. And if you purchase a bond in 2004, then you will have only 1 year and the bond will mature. Coupon rate is the interest rate, because you're talking about a loan, so on a loan there is always interest. So coupon rate is the interest rate, and coupon payment is the interest in terms of dollars on in terms of PKR, and it is calculated by coupon payment is equal to coupon rate multiplied by its face value. So let's look at an example to understand these terminologies even better. For example, Engro Corporation issued a 10% bond with a face value of 1000 and 5 years of maturity. So this 10% over here is the coupon rate. This is the coupon rate, this is the face value 1000. So this is the loan amount. If you purchase one bond, it will be considered that you have given a 1000 loan to Engro Corporation, and the maturity is 5, so N will be 5 in this case. Now the first thing is, what is the interest amount then? What is the coupon payment? Coupon payment is coupon rate times the face value. The coupon rate is 10% and the face value is 1000. That means the coupon payment is 100. So how do the payments work? Usually your bonds have semi-annual payments, but for simplicity we will just assume right now that the payments are annual, and we will later incorporate the semi-annual assumption. So at the end of first year, 100 is the coupon payment. As an investor, if you have purchased a bond, at the end of 1 year you will get 100, at the end of second year you will get 100, at the end of third year, at the end of fourth year, and at the end of fifth year. For all of the 5 years, every year you will get 100 PMTs, coupon payments. Plus after 5 years, when the bond ends, you will get the 1000 par value back. So once you get the 1000 par value back, which means the loan amount has been given back to you, the bond will cease to exist. जब उधार आपका वापस करते तो जाहिर सी बात है अब आपको उसके ऊपर कोई इंटरेस्ट नहीं मिलेगा, बॉन्ड यहीं पे ख़त्म हो जाएगा. So this is how a bond works. You can see a very clear difference between bond and a loan. Okay, you have already studied how to make a loan amortization schedule. Loan amortization schedule, once you made it, you saw that with every year you actually return the loan balance as well. The 1000 loan balance, if it would have been a loan, it would have been returned with each and every payment. But because it is a bond, the loan is not, the par value is not returned anywhere in the middle, and it is only returned at the end of the 5th year. The second step, or the second part of the topic, is valuation. So what is valuation? Valuation is the process of determining the current worth price of an asset or a company, and there are 3 steps involved in valuation of financial asset. Number 1 is you need to estimate the cash flows. So the cash flows of a bond will be the coupon payments, the interest payment, and the principal amount, the par value amount. Then you will use an appropriate discount rate, which will be the market interest rate, and third will be that you will calculate the present value of these cash flows. Once you have done all of these 3 steps, you will get the price of the bond. You will figure out what is the worth of the bond. Okay, we'll come back on this later. So let's look at an example. It's the same one. So we already know the cash flow of this bond. So the first step was estimating the cash flows. So here you go. Here are the cash flows. These are the cash flows for this bond. It is the same one that we started off with. Now you need to use an appropriate discount rate. So the appropriate discount rate is given to you. Market interest rate discount rate for a similar security is 8%. The third step is that you need to calculate the present value of these cash flows. So if you use the most simple formula, which is present value is equals to future value 1 plus r power n. You can use this formula. Now you will have to calculate the present value of these cash flows. So this cash flow will go back 1 year, that's why power 1. This one will go back 2 years, so power 2. This one will come back 3 years, so power 3. This one will come back 4 years, power 4. Now the last cash flow is not only 100. You will get the 100 coupon payment plus the 1000 loan amount will also be given back to you. So the last value is 1100. The total cash flow is 1100. You will discount back this 1100 for the whole 5 years. So if you calculate this, your answer is coming 1079.85. This is the price of the bond. This is the value of the bond. And because the value is greater than 1000, it is greater than 1000, we say that this is a premium bond. And it is a premium bond because you can see from the interest rate. This bond is offering you an interest rate of 10%, whereas similar securities in the market are offering you an interest rate of 8%. So this bond is actually better than the market. When it is better than the market, the demand of this bond will be more, and automatically the price of the bond will go up. So demand and supply will adjust itself, and the bond price will go to 1079.85. So this was a maturity where you were dealing with only 5 years, but sometimes your bond can have a maturity of 15 years, let's say 30 years, 60 years. So if you do it this way, the process will become too tedious. So there is a shorter way of doing this, which is to use the annuity formula. So from now onwards, we will use this formula in order to calculate the bond value. In this formula, CP stands for the coupon payment, R is the interest rate, N is the number of years, and M is the maturity value, par value, face value. R is again the interest rate, and N is the number of years. So we will use both of the formulas on these examples. So it's the same question, but now the market interest rate is 12%. So if you use the single cash flow formula, you will calculate it this way, and your answer will come 927.9. So you can see that we have changed the R over here to 12%, and the cash flows are still the same, and you have to discount them back for 5 years. So one way of doing this is this, and the other way is to use the bond value formula, which uses the annuity factor. The coupon payment over here is 100. R is the interest rate, N is the number of years, and 1000 is the maturity value, it is the par value, and R is the interest rate, and N is the number of years. So if you solve this, you can see you will get the same answer, 927.